Thanks for tuning in to a special edition here of our weekly investment webcast that we call Cutting Through the Noise. I'm Tony Welsh, Chief Investment Officer here at Signature FD. So here's what's on our agenda for today. We're going to talk about tariffs and the impacts we're seeing there thus far, and then we'll spend a little time on the economy at large. We'll discuss consumer trends and also what could help support the market if it gets out of its slump here in the upcoming weeks. So first, we're going to start with this public service announcement. Corrections are totally normal, though they don't happen for no good reason. There's almost always an impactful news flow that is working to drive the corrective market action. And as we'll discuss here in a second, this correction is being driven by trade policy uncertainty and some economic softening. Now, the average year actually sees over three separate 5% corrections and even includes a 10% drop at some point. Part of being an investor is being willing to take the risk of an uncertain future, and often that does mean taking some drawdowns along the way. So let's touch on tariffs. So the first round of tariffs are a big deal because they do target our three largest trading partners. Here's a chart showing the percentage of imports that come from Mexico, China, and Canada. Now, the percentage has been shrinking with China, stable with Canada, and growing with Mexico. Together, we get about 40% of our imported goods from these three countries. Now, policy has been changing rapidly with tariffs going on and off and exceptions here and there. But if 25% tariffs on Mexican and Canadian imports, as well as that additional 10% on Chinese imports, did go all the way into effect, it would be about a 5 times greater impact than the 2018 announcements. The weighted average tariff rate would go from about 2.5% to 7%. The impact to corporations would approximate a 10% rise in taxes or a $150 billion hit to earnings, assuming that companies couldn't pass on the tariffs. As this really is a big change in trade policy, you're seeing a very large spike in general economic policy uncertainty. So that's what the middle clip of this chart in orange is. In the blue on the bottom, it's showing uncertainty relative to its average of the past 4 years. What's significant is that the economy tends to struggle when economic policy uncertainty is this high. It's really being primarily driven by trade policy uncertainty right now. And it's just difficult for corporate executives to make decisions when they don't have good visibility into the rules of engagement. Now, reading the tea leaves from members of President Trump's cabinet, they're trying to flip the fiscal and monetary mix to control spending and work on the national debt. Now, this chart shows the economy in blue in the top clip, and in the bottom clip, it shows fiscal policy in orange and monetary policy, or better known as Fed policy, in black. Right now, they're both accommodative, but that's resulted in large non-wartime budget deficits. What the administration would seemingly prefer is tight fiscal but lower interest rates or easier monetary policy. That's actually been a pretty good mix for economic growth, which makes intuitive sense. Typically, fiscal policy is easiest when the economy is in a recession. Tight fiscal, loose monetary, that tends to mean that economic growth is solid and inflation is low. For stocks, the monetary mix almost certainly matters more than the fiscal mix. Stocks have tended to perform best when the monetary policy is accommodative, basically regardless of fiscal policy. Don't fight the Fed is a long-time Wall Street rule of thumb for good reason. Now, the administration may be attempting to run tight fiscal with loose monetary, but much of that will depend on whether the economy is growing and what is going on with inflation. The Fed is not likely to cut if inflation remains high, in the absence of a weaker labor market particularly. Alternatively, if the economy did succumb to very weak growth or maybe even a recession, it would be quite difficult to run that tight fiscal policy. Now, given all the trade and economic uncertainty, as well as the pretty quick corrective market action we've experienced, investors have quickly gotten very pessimistic. In orange in the bottom clip here is a survey from the American Association of Individual Investors. It compares the number of people who are bullish to the total number of bulls and bearish investors. You can see that sentiment has really fallen off a cliff down to levels that are typically associated with much worse market environments. The good news is that rallies do tend to start from a place of extreme pessimism, and we can pretty clearly see plenty of pessimism today, whether that's in investor sentiment or even consumer sentiment. Now, there's been some press coverage lately of the Atlanta Fed's GDP Now calculation. They take incoming real time data to try to forecast where economic growth will land when all is said and done. And for Q1, they're showing a pretty sharp negative print for the economy. Now, a few comments. First, this likely greatly overstates the economic weakness, but there has been some economic softening to start the year. The reason it's overstating weakness is because it's counting imports as a huge drag on growth. Here in red on this chart, we're showing the trade balance, and we can see that we've never come close to importing this much more than we export. Companies appear to have been front-running tariffs and supercharging their orders. Additionally, this looks less severe when you strip out gold imports. What actually is a little more troubling to us is the contraction in consumer spending. This expansion since the pandemic has been driven by a strong consumer. In January, we saw consumer expenditures contract for the first time since early 2023. That was driven by a large contraction in goods spending. And that's in line with consumer surveys where consumers are reporting that now is not a good time to make a large purchase like a house, car, or a major appliance. Now, this could reverse if policy uncertainty quickly cleared up, and we don't want to see this as a drag for much longer. But even before the uncertainty spike heading into this year, we did expect economic growth to ease. The reason was that real incomes have been growing, but the growth rate has decelerated. Over the past year, real disposable income rose 2.1%, which is below the average of 2.8%. And the trend does look to be lower for now. Now, this can improve through some combination of higher wages and or lower inflation. But for now, consumers do not seem to have as much spending power as they have in the prior 2 years. Not all is bearish, though. There is silver linings out there. The first is interest rates. Rates have been easing for much of this year. If the economy were to weaken, we would suspect that rates would fall even a bit more. And that could work as something of a stabilizer if it encouraged housing activity to pick up. And the other positive is that for now, corporate earnings are supportive of the stock market as well as the economy. Earnings grew strongly in 2024, and analysts estimate that earnings growth may continue to be strong in 2025. Of course, that would not likely to be the case here if a recession were to hit. But for now, corporations are highly profitable, and that tends to provide support to the labor market. From a market perspective, what we really need to watch out for is that dreaded stagflation. Stagflation is a combo of weak economic growth and higher inflation. In this chart, stagflation would be defined as economic growth that was lower than potential and inflation that was higher than the last 5-year average of inflation. So inflation trends are still benign enough that I don't think stagflation is the appropriate characteristic of the macro backdrop today. But it is an environment of lower economic growth. Historically, stocks have provided positive returns in every economic and inflation combo, with the big exception of stagflation. It's possible that tariffs do create a one-time pop in inflation that make things feel stagflationary for a period of time. So we're cognizant of that. So to recap, trade policy and to an extent immigration policy are creating a high degree of economic uncertainty, and that's probably going to result in a drag on Q1 economic growth. The economy can probably withstand a shorter period of uncertainty, but if it drags on for multiple quarters, the headwind could push us into a real contraction. Now, real income is slowing, but it's still solid, and interest rates have been falling. Those things can act as supports. What we're on the lookout for is something of a stagflationary environment. That's historically been a negative combo for stocks. For now, we would not define the backdrop that way, but we do acknowledge that economic growth is softening. Our major theme for this year is diversification and portfolio rebalancing among a more challenging investor environment. And thus far, that's really been the case. Now, as always, thanks for tuning in. Next week, we'll go over inflation data and anything relevant from the consumer confidence survey that we get later in the week as well. As always, please have a great week ahead.